Today we're going to talk about the Democratic Caucus's version of the Owen-Glass bill and what it set out to fix. Basically, this is the bill that that was originally drafted to create the Federal Reserve. So by October 1913, the banking reform fight had moved from think tank blueprints to a concrete bill, the Owen-Glass bill, as submitted to the Democratic Caucus. So, Warburg treated this draft as a serious step toward modernizing U.S. finance and a revealing snapshot of what lawmakers thought actually needed fixing after the panic in 1907. So, at its core, the caucus aimed to do four things. One, it mobilized scattered reserves into regional reservoirs so liquidity could move where needed without New York's call money whiplash. For two, so it would create a true discount market built on short, self-liquidating paper and acceptances, so rates could be guided by a posted schedule rather than panic. 3, it replaced bond-secured currency logic with elastic credit anchored in real bills. And for 4, it balanced decentralization with coordination through a new Federal Reserve Board and a system of reserve banks. The political compromise, was 12 banks with a strong federal oversight, tried to tame fears of a single, quote, Wall Street bank while still attacking the reserve problem. So, what problem set was the bill actually tackling? First, the New York call money trap. So funds gushed into New York in easy times and rushed out in stress, causing violent convulsions that made Wall Street, end quote, a ruler on the keg of dynamite. A modern reserve system, Warburg argued, would trade that for a constitutional federation of credit, many reservoirs with common rules. Secondly, the scattershot reserves. So the bill's framework, regional reserve banks with member balances at the center, was meant to mobilize vault cash. Warburg cautioned against impounding too much cash in bank vaults. Better to hold working balances with the reserve banks, which count toward a bank's reserve position, and let those balances justify access in case of need. That is the reserve mobilization logic at the heart of the Owen-Glass bill. So third, the bill tried to stand up a discount market. So Warburg's critique is instructive. So unless the law ultimately creates a market for bills and bank acceptances and a free interplay of reserves between centers, it won't achieve its purpose. That's the target: short, trade-tied paper clearing at posted rates, so seasonal bulges, for example, the cotton move, draw funding smoothly from everywhere without the spasms. So why are there 12 reserve banks? And what did that actually try to fix? So politically, the caucus bill opted for multiple districts to calm fears of an absolute centralization and a single national rate, an explicit response to the anti-Wall Street sentiment. So functionally, the hope was that regional rates and governance would reflect local conditions while still living under a common rulebook. Warburg accepts the politics but flags a risk. With 2 cabinet officers on the board and vast powers at the center, the design could slide into direct government management, the very politicization the reformers feared. That tension, plural banks to diffuse New York, but a strong board to hold the system together, defines the caucus version. So, also the branches and local knowledge. So the bill was fuzzy on branch powers. Warburg worries that if discount decisions bottleneck at a distant board, the system will be slow and cumbersome and stifle a free discount market. He argues for local discount committees and boards, so paper can clear quickly while the composite board handles policy. That's a fix-the-plumbing critique. So aimed at making the bill's intent, fluid credit, actually work on the ground. So Warburg's own memo was retitled as submitted to the Democratic Caucus once House leaders endorsed the revised Glass bill. He circulated it to Wilson, McAdoo, it's President Wilson, McAdoo, Glass, Owen, and others to spotlight constructive changes and lingering defects. The context matters. Reformers largely agreed on reserve concentration plus elastic credit. The fights were over how many banks, how political the board should be, and whether the bill truly built a bill market. So the caucus bill tried to fix A, volatility born of scattered reserves in call money finance, B, the absence of a national discount/acceptance market, and C, the credibility gap that came from either over-centralizing on Wall Street or over-politicizing in Washington. Its cure was regional reserve banks under a federal board, member balances at the center, and a rules-anchored discount regime with details like branches and rate setting still rough. So, to conclude, think of the Owen-Glass, the caucus draft, as kind of the bridge form from panic-era improvisation to a playbook. So mobilize reserves, publish rates, clear trade bills fast, and share liquidity across the districts. The politics of 12 banks tried to allay old fears, and economics aimed to lock in elastic trade-tied credit. The remaining question is whether the bill's governance and mechanics were tight enough to make the promise actually real.